Stop scrolling. If you're watching silver right now, you're early. From the mid-'80s, silver ripped past $85, testing the psychological $100 barrier while dealer inventories drained across the board. Premiums that should compress on dips, holding firm. Delivery windows that ran 2 to 3 days, now stretching to weeks. Warehouse stocks that shuffled quietly, drawing down hard. If you're holding physical, watching COMEX, or stacking ounces, this affects your positions this week. Most people will notice after $100 prints. We're here before the crowd. Your job isn't to predict the top. It's to understand the structure underneath, the patterns that repeat every cycle, the signals that speak before headlines scream. The real tell won't show up on price charts. Let's dig in. Hit subscribe button and leave a comment saying, "Hey Graham," so I know who's watching. We track what gets ignored until it's too late. Drop a comment. What premiums are you seeing in your market right now? Physical buyers in different regions see stress at different times. Community data beats any single data point. Now here's the situation. Silver surged 30 or 35% into early 2026, blasting through resistance levels while something shifted beneath the surface. Why does this matter? Price is a lagging indicator, always has been. Flows move first. Availability tightens first. Pressure builds first. Then price catches up. What you're not seeing on the chart, lease rates, the cost to borrow physical silver for short-term delivery, quietly spiking in the front months. That's not normal market noise. Physical premiums refusing to compress when spot pulls back. In a healthy market, premiums breathe with price. Right now, they're locked. COMEX registered warehouse stocks, the ounces actually available for delivery, drawing down while eligible, stored but not deliverable, stays put. Paper positioning crowding one direction while physical gets rationed. This is stress, hidden stress, the kind that doesn't announce itself until the valve blows. If premiums don't fall on dips, something's wrong. Circle that. Let me show you the mechanism. I call it the pressure valve. Simple concept, brutal in practice. Think of it like a sealed pipe. On one end, you've got paper leverage building, futures contracts, options, synthetic exposure, massive notional value controlled with minimal capital. On the other end, physical tightness increasing. Fewer ounces available for immediate delivery. Longer wait times. Pickier dealers. Pressure rises on both sides. When delivery risk spikes, when someone holding paper suddenly needs physical and realizes the cupboard's thinner than expected, the valve releases. Price vents in bursts. Not smooth, not predictable, violent. Here's the current application. Front-month lease rates jumped while deferred months stayed calm. That's short tenor stress. Someone needs silver now, not in 6 months. Premiums holding at 3 files over spot even when price dipped to $3. In normal conditions, that premium compresses immediately. Dealers compete, spreads tighten, you get deals. Not now. Spreads between front-month futures and deferred contracts tightening instead of maintaining gentle contango. The market saying, I want delivery soon, not later. And registered COMEX inventories declining while open interest stays elevated. That's the valve under pressure. Why does this pattern repeat? Because leverage resets don't fix supply. A short squeeze unwinds. Volatility drops. Traders cover. Position limits get enforced. But the physical metal that got pulled from warehouses doesn't magically reappear. Industrial demand doesn't pause because speculators got shaken out. Deficit conditions don't reverse because futures rolled over. The paper side can reset overnight. The physical side moves like molasses. That asymmetry is the pattern. I've watched this play out in 2011, in 2020, in every mini squeeze between. Different catalysts. Same structure. Paper builds faster than physical can respond. Tightness emerges, prices hesitate, then release. Your job isn't to time the release. Can't be done consistently. Your job is to recognize when pressure's building before the valve opens. Watch the spreads, not the headlines. Headlines tell you silver hit 80 out. Spreads tell you someone's scrambling for March delivery while May sits quiet. One's a number, the other's a signal. Now let's add the second layer. Rationing before repricing. It connects directly to the valve. Before price explodes, availability disappears. Dealers don't announce it. No press release saying, "We're rationing silver now." It shows up subtly. Longer wait times. 2 weeks for delivery becomes, "We'll call you when it's available." Higher premiums that don't budge. Spot dropped $3, but our premium stayed at $450. Selective fulfillment. We can do 100 ounces, not 500. Order minimums rising. We're only taking institutional size now. Imagine you're a small dealer. You've got standing orders from regulars, industrial clients who need ounces monthly, retail customers who buy dips. Your supplier, the next level up the chain, just told you allocation's tightening. What do? You prioritize your biggest, most reliable clients. You stretch timelines for everyone else. You raise premiums to slow demand without losing margin. You ration. Not because you want to, because upstream supply squeezed and you're protecting relationships. That's happening now across dealer networks. Wholesalers seeing longer lead times from refiners, refiners seeing tighter doré supply from miners, miners running at capacity with no quick ramp available. Meanwhile, industrial demand, solar panels, electronics, medical equipment, doesn't care about your investment thesis. They're buying forward, locking supply, front-running restocking cycles. If you're a fabricator and you think silver's headed higher, you don't wait. You secure 6 months of inventory now, even at elevated prices. That pulls available ounces off the market before retail ever sees the tightness. The price chart shows $87. Behind the scenes, ounces are being allocated, rationed, and reserved. When dealers ration, charts catch up. Eventually, could take weeks, could take days, but the sequence almost never reverses. You don't see prices spike first, then availability tighten after. That's not how commodities work. The physical world moves slower and signals earlier than the paper world. Not telling you to front-run this, showing you what to watch. If you're seeing longer wait times, rising premiums that don't compress, dealers limiting size, you're seeing rationing. Price is the trailing indicator. Think about that. Here's what you need to sit with. What if the next major signal isn't price, but silence? Not a surge past $100. Not a crash below $80. Silence. Dealers stop answering about availability. Call back next week. Websites show out of stock without restocking dates. Premiums listed as call for quote instead of fixed numbers. Warehouse withdrawal reports go quiet. Not because nothing's moving, but because everyone who's pulling doesn't want others to know. That's the eerie phase before repricing. The stakes aren't theoretical. It's who gets filled versus who waits, who locks supply at $85 versus who's chasing at $95, who understood the difference between price and access. You can have money and no ounces, or ounces and watching others scramble. The valve doesn't care about your entry price. It cares about positioning when stress peaks. We're not there yet. But the pressure's building. Hold that tension. Let's map the paths from here. Base case. Grinding higher with firm premiums. Silver pushes toward $95, $100 over weeks, not days. Premiums stay elevated. $3 over spot becomes the new normal. Dealer inventories stabilize at lower levels. Volatility stays contained, but bias remains upward. Who wins? Patient accumulators using dips. Physical holders who secured supply early. Who loses? Leveraged longs expecting moonshots. Shorts assuming mean reversion. Stress case. Volatility spikes. Spreads invert briefly. Availability chokes. Some catalyst. Industrial restocking surge. ETF inflows. Derivative unwind. Forces delivery demand. Front-month futures trade over deferred. Backwardation. Premiums jump 8 to 12. Dealers ration aggressively. Price gaps $5 to $10 in low liquidity windows. Who wins? Those with physical already secured. Traders who respect position sizing. Who loses? Late chasers. Over-leveraged bulls. Anyone relying on just-in-time delivery. Relief case. Temporary pullback. Watch if premiums crack. Profit-taking or macro headwind pushes silver back toward 80-83 volume drops. Volatility compresses. The key tell, do premiums collapse? If premiums drop from $4 to $0.50, stress was overblown. Market's healthy. If premiums hold at 2.3 even with price down 5, the underlying tightness didn't resolve. Who wins? Disciplined buyers adding on weakness if fundamentals hold. Who loses? Weak hands shaken by normal volatility. Those who mistake price pullback for structural relief. No guarantees. Could pivot between scenarios within days. What we're tracking this week. Not advice, pattern recognition. Here's the watch list. First, front month versus deferred spreads. Normal, gentle contango. March trades 0.20, 0.1, $40 below May. Carry cost reflected. Stress. Spread tightens or inverts. March trades at or above May. Market wants delivery now. Interpretation. Tightening spread signal short-term scramble. Doesn't predict peak, but confirms pressure. Second, dealer premiums versus spot on pullbacks. Normal. Premiums compress when spot drops. Price down $3. Premium falls 1 to 2. Stress. Premiums hold or rise. Price down $3. Premium stays flat or climbs. Interpretation. Sticky premiums reveal underlying supply tightness. Price isn't relieving physical demand. Third, lease rates. Short tenor jumps. Normal. Lease rates flat. Sub 1% across maturities. Stress. A 1-month, 3-month rates spike to 3.8%, while 12-month stays calm. Interpretation. Someone needs to borrow physical short-term. Classic delivery squeeze setup. Fourth, registered versus eligible warehouse stocks. Normal. Registered shuffles between warehouses. Eligible stays stable. Stress. Registered draws down consistently. Eligible doesn't convert to replace it. Interpretation. Deliverable ounces shrinking. Paper claims aren't being challenged yet, but the cushion's thinning. Fifth, volatility during low liquidity hours. Normal. Overnight. Asia hours trade. Calm. Tight ranges. Stress. 3 to 5% swings during thin volume. Gaps on open. Interpretation. Illiquidity amplifying moves. Sign of fragile positioning and tight float. If you're active in this market, here's what I'm respecting. Not telling you what to do. Showing my approach. Liquidity awareness. Tight markets whipsaw. Position size for gaps, not smooth moves. Time frame separation. Trading thesis differs from holding thesis. Don't mix horizons. Optionality thinking, keeping cash for scenarios I can't predict, beats going all in on one path. Patience on entries. Waiting for premium dips or spread normalization even if I miss $2 of upside. Information diversity. Dealer calls, warehouse data, futures positioning. No single source. Discipline over conviction could be wrong. Structure position to survive being early or late. If you're trading volatility, respect that liquidity's thin. If you're holding physical, accept that pullbacks happen and premiums can temporarily spike against you. If you're watching from the sidelines, know that entry points tighten when rationing starts. Your strategy, your risk. Here's the bottom line. If you're watching flows instead of just price, you're in the group that sees turns first. Not perfectly, not without noise, but you're tracking the right signals. Pressure builds before valves open. Rationing happens before repricing. Availability speaks before headlines shout. Those aren't predictions, they're patterns. Patterns repeat because the structure repeats. Paper leverage, physical constraints, delivery risk. The specifics change, the mechanism doesn't. Your job is to recognize the setup, not call the exact top or bottom. Can't be done consistently. Trying will burn you out. But you can watch spreads tighten. You can track premiums holding on dips. You can see warehouse stocks drawing while open interest stays elevated. And you can position accordingly, not with certainty, with structure, engagement time. Binary question. Did premiums in your market compress during the last 2-3 dip, or did they hold firm? Drop your observations in the comments. Regional data matters. If you've experienced longer wait times or allocation limits from dealers, share that too. Real-world confirmation beats theory. And if you've caught a win by watching spreads instead of price, post it. Community wins help everyone learn. Hit subscribe if this breakdown added value. We're building a group that tracks ignored signals, shares real data, and stays ahead of headlines. No hype, no guarantees, just patterns and watch lists. Final insight to carry forward. Scarcity speaks before price. Always has. Always will. If you're listening, you're positioned. If you're chasing headlines, you're late. Stay sharp.